2 days of losses on the S&P 500. Can we make it 3? Equity futures right now down about 1/4% on the S&P. On the Nasdaq down about 1/10%. Last couple of days, over the last 2 days, we're down by about 1.6% on the S&P. On the Nasdaq down by about 2.6%. Still up on the year. Big time. There's your opening bell. Switch to the board and get to the bond market. Yields look a little something like this, turning higher by a basis point, about 3 hours away from hearing from Chairman Powell. Your 10-year 365, your 2-year nicely through 440 in the last 24 hours. Right now 445. It means some more dollar strength and euro weakness. Euro dollar last week, high of the week, high of the year, 110.33. Now back down to 106.92. We're down 1/3% on that currency pair. Looking at crude, we're positive 1 full percentage point, just short of 75 at $74.90. About 30 seconds into the session, no real drama here. Down 0.2% on the S&P, and the Nasdaq virtually unchanged. One stock to watch at the open, Royal Caribbean, reporting a smaller than expected loss with pent-up demand helping to offset rising fuel prices and a strengthening dollar. The CEO said this: travel strength continues as consumers shift their spending towards experiences, with cruising remaining an attractive value proposition. Apparently, Abby. Hey, Abby.
I'm with you on this, John. I was not a cruiser ahead of the pandemic, and I'm certainly not now, but apparently a lot of people out there are, and there's new cruisers too, because bookings, that's the key to this story. Very, very strong, taking the stock higher. Its best day in almost a month, and it also suggesting that they are going to have record EBITDA for 2023. So there's lots of optimism about 2023. That quarter that just was, it was a little messy. Yes, they did put in a narrower loss than expected, but it was still a big loss. Sales were a little bit of a miss, but looking ahead, they are again looking at that record-breaking wave season that you were talking about for the quote-unquote cruisers. Translation, that means that the bookings between January and March are very strong, and it comes off of a quarter that, even though the quarter was a little messy, more bookings than 2019. Imagine that. What's interesting here, though, John, the stock is still 48% below its pandemic high. For 2023, we are again looking at record EBITDA. We're looking at sales that were higher than 2019, so I'm betting that there are a lot of investors out there in Royal Caribbean that are hoping the stock follows those bookings, EBITDA, and revenue.
It's not a comment on the stock. I just don't ever want to go on a cruise. I always see the commercials for cruises, and they always say at the end you can make new friends. And I'm like, I don't want to make new friends, and I certainly don't want to meet strangers in the bar every single night. I mean, that just does not appeal to me. You want to go on vacation and get away from people, not bump into the same people and get trapped on a boat. That's over. Abby, thank you. Another stock to watch, Pinterest. The company reporting sales that missed estimates amid an advertising slump. The CEO said this: we are very much focused on making sure that we return to user growth, but we are more concerned about driving deeper engagement. Kelly Lyons wants to talk about that, and I know she's got a rant of her own on cruises.
I just really want to tell you, you can't knock it till you try it, John. I am totally a cruise person. It's not about having to interact with people. It's about getting on the boat, and you don't have to do anything else. It'll take you to all those different places. Anyway, Pinterest, which admittedly I also was a user of, especially when I was planning a wedding, isn't doing so well when it comes to the top line numbers. The stock's down about 0.8% as a result. This really is an advertising story, John, because this is obviously a social platform that gets its revenue via advertisements. And we know that there is an advertising slowdown, which is why they just saw their lowest pace of revenue growth on record, 3.9%, really coming down from the highs we saw prior to the pandemic and then over the course of it when everything online was doing so well. But now it is a very different story. And to put it in the words of one analyst over at Baird this morning, this is a second-tier player. So if advertisers are pulling back, the dollars that they do spend are likely going to go to the bigger players like Alphabet or Google and Facebook. Those have about 70% market share compared to just 0.6% for Pinterest. So that paints a pretty tough picture for them there. If there is one bright side, though, that the sell side is pointing out today, is that engagement and user trends seem to be improving. Engagement like pins and comments is up about 10%, and they did just fractionally beat on monthly average users as well. So maybe that is why we are seeing not too deep losses in the stock this morning, though now they do seem to be deepening a bit, down about 2% before the bell. Also, go cruises, John.
Kelly, I'll let you have the final word. Kelly Lyons, thank you. Also keeping an eye on Bed Bath & Beyond, shedding nearly half its market cap after announcing plans to raise $1 billion through an equity offering. Wedbush cutting the stock's price target to zero, running in a note. We see these capital raising transactions as a last gasp to survive before filing for bankruptcy protection, where the common equity would likely be worthless. Bloomberg's John Edwards joins us now. John, fantastic to catch up with you. Run us through the state of play here and the chances of avoiding bankruptcy.
Yeah, it's an open question still. I mean, Bed Bath & Beyond, by its own admission, has been at the brink of bankruptcy for weeks now, and it did, late yesterday come up with this last-minute reprieve, offering some preferred shares and warrants to raise about $1 billion. So that should help it stave off a Chapter 11 filing in the immediate term. However, as you see, analysts are skeptical that this is going to be a long-term rescue for the company. It still has to fix its severe operational problems. It's having trouble keeping its shelves stocked. It's having trouble appealing to shoppers because they see that they're not able to find what they are looking for. So that remains an open question, and we'll have to see if this is really the rescue that they think it is.
Well, John, when you say the immediate term, I know this is so tough, so difficult to answer, but how much time have they bought?
Some analysts are saying, maybe a couple of quarters, maybe a little bit more, but it's again, they've really got to get that operational situation turned around quickly. I mean, they've had double-digit declines in same-store sales for several quarters now, and it's just it's not a healthy situation for them.
That stock has been all over the place. John Edwards, John, thank you. The stock is down by about 39% in early trading. 6 minutes into the session, the broader equity market on the S&P down 0.25% on the Nasdaq, down 1/10. Citi Stuart Kaiser looking for next week's inflation report to give markets a dose of reality. He has this to say: markets continue to sidestep 23 landmines, with events failing to produce negative enough outcomes and pressuring conservative positioning. We see risk tilted to the downside, with the onus now on CPI to disrupt the apple cart. Stuart, I'm pleased to say, joins us right now. Now, Stuart, before we get into it, there was a great piece in Barron's over the weekend about really short-dated call options. I want to share a quote with you and get your thoughts on it. It said, speculation has returned in another acronym, 0DTE, which stands for 0 days to expiration options. To help traders scratch that speculative itch, the exchanges have been offering ever shorter options until they got to 0 days to expiration. Now, Stuart, can you tell me about the kind of volume that we've seen in those very short-dated call options and what it may be doing to the broader market?
Yeah, Jonathan, it is kind of a new theme. I think it's a little bit distinct from the sort of retail options flows that we saw a couple years ago. But basically, in the S&P 500, you're trading about 45% of your total options volumes in options that expire by the end of the day. So call it about half of the options that are being traded expire, at the close of business on the day. So it's a huge thing. I would say the impact on the market is a little bit harder to discern. It's a lot of volume, it's a lot of churn going through the market, but contrary to other sort of fads we've seen in the last couple of years, which was very much people buying call options to have upside risk, this trading of zero-date options is actually much more balanced between puts and calls, and I think for that reason you're kind of seeing it impact the market a little bit less on an intraday basis. Some people have speculated it's one of the things that's driven high intraday volatility because it's allowing people to add leverage to their kind of intraday risk-taking. And I think that's a possibility and still an open question. But regardless, it's a massive theme in options markets these days.
Well, what I'm trying to figure out is how much of the price action is just a technical story that we're trying to assign a narrative to, a fundamental narrative, Stuart. Just the year-to-date epic rally we've seen in some of these big names.
Yeah, look, I think the zero-date options, though, generally is not a single stock phenomenon. Most single stocks do not have daily options listings the same way the S&P 500 does. So while you may have people trading short-dated calls, let's say, on a Meta or a Google or pick your large-cap tech company, those are generally not going to be zero-day options because you just don't have 0 days listed for most single stocks. So this is, kind of more of an index phenomenon than it is a single stock story.
Stuart, any
any
difference this year to what you might have seen in years gone by? I remember discussing this in September 2020 and that mount up we saw in the Nasdaq. Any difference to what we're seeing now compared to back then?
Yeah, definitely. I would separate those into two slightly different categories. Back in 2020, this was largely retail investors buying call options in kind of 1 month in expiries on essentially large cap tech or popular names, right? And because that was flow, that was one way into the call wing, it actually did impact the way that options were being priced. In our parlance, it inverted skew, i.e. your call was more expensive than your put, which is highly unusual. What we're seeing today, though, is not really single stock. It's much much more S&P 500, and it's zero date options more balanced between puts and calls. So I think they're similar in that they're new developments. It's a lot of options volume being traded in the front of the term structure, but I would kind of separate out the retail flows going into tech call options from what we're seeing in zero date options on the S&P 500.
So that's the difference between now and 2020. I want to talk about 2022 just briefly. You put out a note in November, and I remember this note, and I went back into it last night just to read through it, and you said this: would inflation crest before growth deteriorates, and let the FOMC deal with those risks to its mandate separately? For markets, how long an investable window is there between these two waves of economic risks? Now, Stu, I'm sure you remember writing that. Now, can you tell me where you stand on that now? How big is that window?
I vaguely remember it. Look, I think, obviously the window has proved to be longer than most people expected, right? I think a lot of people positioned that early in 2023 we were going to be more aggressively trading recession risks and growth risks, and clearly the data to this point has not provided that level of clarity on the downside, and the market's rallied. So from my perspective, I think the window is longer than we expected, and frankly it's much longer than I think the bear case expected. I really do think people came into this year generally very conservatively positioned in the stocks they owned, and owning less stocks than they historically have, in anticipation of kind of hard landing risks on the U.S. economy. And that hasn't played out. And really what it's allowed is allowed the market to rise. It's allowed the Fed to continue to message very hawkishly, because they're not bumping into a severe deterioration in economic data, and particularly the labor markets.
With that all in mind then, Stu, how appealing is it to take on downside protection going into something like CPI next week, or to the risk events on the horizon in the not too distant future?
Yeah, it's a great question. I mean, from my perspective, being here above 4,100 is a very uncomfortable price level to be in, given the views on both economic growth and inflation. So I do think that CPI print is kind of a sneaky risk event, just because investors have largely assumed away inflation risk. So if you were to get a little bit of a surprising print there after what was a very, very strong labor market report, it's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen, because a lot of macro and hedge fund investors in particular are very uncomfortable with the market at these levels. So if you have an excuse to sell it, from CPI, I think they'll take that opportunity. It is not as big a risk as it has been in recent months. I would say from a volatility perspective, it's priced at about 75%. The size of the event's about 75% of what it was last month. So big, but maybe not on par with recent history.
The ultimate risk event last year, as you know, was just pricing the Fed. And if you couldn't price the Fed, you certainly can't price the risk-free asset, treasuries, and you certainly can't price risk. That was because we went from a Fed calling for, say, 90 basis points of hikes last year to pushing through more than 400. There was just a feeling that we'd come into 2023, Stu, a little bit more comfortable, that we would understand that story more, that this Fed would ultimately get to, say, 5 and then stop. And then we'd have this conversation about cutting. After that payrolls report on Friday, do you think it reintroduces the risk we have this conversation about a Fed going to even higher levels than we thought about maybe in the last 12 months?
Yeah, look, I agree with you 100%. I mean, I think one of the big headwinds to risk-taking last year was bond volatility, which obviously came from volatile inflation data and an uncertain Fed, policy path. So this year, as we've transitioned, I think there is less bond volatility, obviously, in the markets, and I think there is less uncertainty about the path of the Fed, right? Even if you think, as our economists do, you're going to get multiple more 25 basis point hikes, that's not the same as going from 25 to 50 to 75, to talking about potentially 100. Right? So the volatility coming from the Fed and from bond markets this year is, I think, undeniably lower than last year. Could it tick up a bit from how it's been early this year? 100%. That labor market report clearly made people uncomfortable. But I think there are some people also looking at that labor data and saying there was something a little odd here in some of these seasonal adjustments. And, if that number had been 300 instead of 500, the markets probably would have reacted a bit differently. So, big picture, yes, there is still some uncertainty from the Fed, but I believe bond volatility and Fed uncertainty is significantly lower than last year, which has certainly helped risk premium. Frankly, I think it's correlation between bonds and equities right now that's the bigger issue.
Final question, Stu, and this is an important one. Katie wants to know, do you like cruises?
Well, you know me, John. I get on a cruise, I read about the Dow, and I just relax, you know. So that's how I settle it. But no, I've actually never been. I've never been on a cruise. I've never been on a cruise.
Never going to go on a cruise. And never look at the Dow. Stuart Kaiser there. City. Stu, thank you. The Dow and cruises. What's worse than that? Coming up, tensions flaring between the US and China.
We made it clear to China what we're going to do. They understand our position. We're not going to back off.
And that conversation still ahead.
We made it clear to China what we're going to do. They understand our position. We're not going to back off. We did the right thing. And there's not a bad question of weakening or strengthening. It's just reality.
US-China tensions looming over Washington as President Biden prepares to deliver his State of the Union address.
All senators and both parties will be briefed by the Department of Defense. The briefing involves where we stand with respect to China on everything from surveillance capabilities to research and development to advanced weapon systems and other critical platforms.
Emily Wilkins down in Washington joins us for more. Morning, Emily.
Good morning, John. Well, obviously this balloon has raised a lot of concerns in Congress on a bipartisan basis. You've heard that Republicans are interested in looking into some sort of resolution condemning China's government for the balloons and looking into as well as what the nature of these balloons are. We're now hearing reporting that there were a number of them during the Trump administration. That, of course, raises questions about what they're going to look like. And it will be interesting to see if Congress can actually muster a bipartisan support here. Initially, Republicans wanted some sort of resolution condemning the Biden administration for how they handled it. But there are also thoughts within both parties, really, that the focus here should be on Beijing and on China. Certainly we'll be keeping an ear open tonight to hear whether President Biden is going to be mentioning Beijing in any of his remarks. It is one of the few issues right now where Congress is unified. You see a lot of Republicans and Democrats be on the same page when it comes to China. And while we're expecting an all-hands-on-deck briefing for the Senate on Thursday, the House has requested similar. Also expect this to come up in hearings throughout the year. I spoke last year with Congressman Mike Gallagher. He's the head of the House's China Task Force, and he says that he does see this as being a part of further hearings on the U.S.'s relationship with China and what, if any, intelligence China was trying to gather through sending balloons over the U.S.
Emily, thank you. Thank you very much. A big question, I think, for all of us in this market now is what does it mean for you if you're invested in Chinese equities? The rally that we've seen over the last 6 months or so, 4 months, go back to the end of October. Baidu since then is up more than 100% since the end of October. It's up 11% today. A year or so ago, China was uninvestable. We said this yesterday. Now, seemingly for many people, it's unavoidable. After the events of the last week or so, Katie Lyons, what is it now? And for this stock, it's got its own story, hasn't it?
Yeah, it's been absolutely remarkable. Obviously, you have the wider picture, the reopening frenzy around China, but you have the artificial intelligence frenzy as well, and that really is what is specific to the Baidu story today. They have said that next month, in March, they are going to launch their own ChatGPT-like product, that AI bot that has caused such a stir over recent weeks, John. They are going to call it Ernie Bot for what it's worth, but really this is just evidence of the competition and race to become dominant in AI. That is true for the U.S. and China, but private companies as well. We have seen just really remarkable moves in many different stocks related to the sector, like NVIDIA, for example. There is crazy funding going into companies that are investing in AI. We know Microsoft has unveiled billions of dollars into OpenAI, which is the operator of ChatGPT, and they're scheduled to have some kind of mystery event today, so we'll see what details, if any, we get about that. But just to underscore how much buzz there is about artificial intelligence at the moment, check out a chart my producer Dan Curtis made for me showing the news trend of articles about AI. It has absolutely boomed. You can see that there on the far end of this chart. So really it is about competition and trying to get in on what the market perceives, at least, as the next big thing, John.
Do you remember the end of 2017 where it was everything with Bitcoin and we saw those companies just renaming themselves?
Yep, just get it in the name to get around the hype. It feels very eerily similar.
Everyone piles in. Katie, thanks for that. Katie Lyons there. Abigail Doolittle has the sector price action for you. Hey, Abby.
Hey, John. Yeah, and it's a little interesting here. So we're looking at a small loss for the S&P 500, down about 0.2%, but we have some pretty wide moves. To the downside, it is all about defense, utilities, consumer staples, real estate. They are all down there. Consumer discretionary is also down there, so that's obviously one of the mega cap tech sectors. But the fact that you have consumer staples and utilities down, both of those being high dividend yielding sectors, suggests that on a day like today, when yields are basically flat, maybe investors are expecting yields to go higher. Up top, though, we do have some growth sectors of technology, materials. Energy is also up there. And you and Kayla were just talking about that China tech story. Well, there it is from sort of the October low, but pretty amazing, up 42%. I found another measure, John, up closer to 60%. So yes, investors seem to be back in on that trade.
Abby, thank you. Two main risk events. I guess there's one really. Later, 12:30 Eastern time. It's Chairman Powell, Volume 2. Any different to what we heard from last Wednesday after that blowout jobs report? 517,000 jobs. No idea where that came from. Unemployment at 3.4%, the lowest since the 1960s, and wages didn't pick up too much. I wonder what Powell thinks about that. Certainly, the President of the United States will be using that report in his address a little bit later. Up next, your trading diary from New York. This is Bloomberg. 25, 26 minutes into the session. Pretty marginal stuff here. No real drama, as we've said a few times this morning. 3-day losing streak on the S&P. We're down about 0.2% on the NASDAQ, up about 0.1%. That's the price action. Let's get you the trading diary. Coming up, Fed Chair Jay Powell speaks from Washington at 12:30 Eastern. Plus, President Biden delivers his State of the Union address later this evening. We get earnings from Uber and Disney on Wednesday. A host of Fed speak through the week. Williams, Cook, Barr, Bostic, Kashkari, Waller, all on the agenda. Thursday morning, jobless claims onto Friday. The UMich Sentiment Survey to close out the week. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, February 7th. Here are the top market stories we're following for you at this hour. Powell versus markets, round two. Fed Chair Jay Powell will speak with David Rubenstein at the Economic Club of Washington. We'll see if markets finally listen up. For now, though, markets pretty much go nowhere. Fed officials sound the hawkish drum. Stocks move a bit lower. Two-year yield climbs. And buyback pain and a billionaire tax. Wall Street braces for President Biden's State of the Union as a recent poll says most Americans don't believe Biden's done much in the last 2 years. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I feel like we're waiting for Powell, but are we kind of really waiting for CPI next week? Like, is this going to be the trading action until we get real direction?
So it's really interesting, isn't it? Powell spoke last Wednesday, market ignored him or heard what it wanted to hear. You get the payrolls Friday, market sits up and pays attention. And I think maybe that is the model. You're right to sort of put the pressure maybe on the CPI, because that could be the real narrative that is going to develop from here. That is, inflation is going to remain a little bit stickier than anticipated. So yeah, we're all getting very excited about Jay Powell a little bit later on. Should we be?
Yeah, also, would his job be not rattling markets at all? Because they are trying to be more data dependent and not taking an extreme view. I mean, you had Neil Kashkari and you had Raphael Bostic both talking about how you probably have to hike more. Markets don't do anything.
Absolutely. I wonder how many times he's going to use the word disinflation, because my sense was that Wednesday, that was the word that everybody latched onto. Is Wednesday, is disinflation going to now be expunged from the lexicon in terms of the way that the Fed communicates, because the market got ahead of itself, loosened financial conditions, and completely disrupted the message that the Fed was trying to send? So, Alex, this goes perfectly to our question of the day. It's a fairly straightforward one, but I think it goes to the nub of the issue. Will the markets listen to Powell? We probably should have added this time, but let's ask Bloomberg's international economics and policy correspondent Mike McKee that question. Let's ask our chief US rate strategist, Ira Jersey, that question. Mike, let me start with you. Will the markets be listening to Powell, and what will they be listening for?
They'll be listening to Powell. They'll be listening for any kind of deviation from his message on Wednesday when he said we're going to raise rates and we're going to leave rates high. What he didn't say at that time was we're going to go higher than we anticipated. And now that's what you're hearing from some of the other members of the Open Market Committee. So I think what Wall Street is really going to want to know is, does he join that chorus, or does he just say, I'm sticking with what I got, and we're going to stay the course, and we'll see what happens. I suspect that's the most likely outcome from Powell. Keep the markets from overreacting, but that's going to be the idea is, do they go farther than they already have suggested they will?
Yeah, Ira, the bond market's telling me don't get excited about that possibility. What do you think?
Yeah, well, I think we need to start getting a little bit more excited about the possibility that the Fed might go a little bit higher. You know, you look at some internal pricing in CPI right now, and it's suggesting that maybe prices aren't going to come down so fast. I think the important thing that Powell just needs to keep on hitting the market with is that they're not going to be cutting this year. He actually explicitly said that during the question and answer session last Wednesday, and I think he needs to hit on that a little bit more, and maybe even be a little more explicit as to under what circumstances they would actually cut. If he says, look, we're not cutting if there's not significant job losses and if inflation's above 3%, we're going to stay at the peak, whatever that is, 5.25%, 5.5%, wherever that ends up being. And I think that has to be something that he needs to say today to finally try and convince the markets that they're not cutting this year.
That's a huge shift, Ira, in so many ways. If he were to do that, that would represent a move back to kind of state-dependent guidance from the Fed. Is that the direction of travel you think is now required in order to convince the market? Here are some explicit levels. Here are the states in which we will do X and Y. Is that where we're going?
Well, yeah, it's kind of like the reverse Evans rule, right? Back in the past, we had the Evans rule. Like, here's the situation where we would actually, where we want things to go before we start to hike. In this case, it's just the opposite. It's, here's the situation where we would cut. And look, he wouldn't be saying anything that's outside of the Fed's mandate, right? The Fed's mandate is full employment and stable and price stability. And if, in saying and this more explicitly, like, look, some retail sales numbers being a little bit soft, there being some weakness in the economy when you still have job growth, that's not a bad situation for the Fed, quite frankly, and something that I think they would like to engineer, because it's hard to have a recession without job losses. So I think that's really the Goldilocks scenario, and by being more explicit about the reaction function of the Fed, I think that's what it would take in order to get the markets to stop pricing for these significant cuts over the next 18 months.
Yeah, I even wonder if that would do it. Mike, then you have the ISM services also on Friday, right? And I'm wondering if that number takes the disinflation conversation away from Powell a little bit today.
Oh, I don't know. I think the disinflation argument that Powell was making was that we're seeing disinflation in some areas of the economy, and that was certainly true in the PCE reports and the CPI reports, but he said we're not seeing it in all of them, and they're concerned about what's happening with the service industries, particularly ex-housing. And the service industry ISM prices paid number didn't go down all that much. So that argument is still out there of we don't know exactly how far disinflation is taking us at the moment, and we want to know more about what's going on. They're going to particularly want to know whether the January jobs number was an outlier, perhaps statistically influenced by seasonal factors, and they're going to want to see if that number of jobs translates into more consumer spending, which then might put some upward pressure on prices. But for right now, they're looking at a pretty Goldilocks situation where things are moving in their direction. They just don't need to change what they're doing. And that's the message the market hasn't gotten yet that, as Ira said, he will try to stress today.
Ira, you've got very excited in the past. Actually, we've got very excited in the past about what you're doing with the model. Should I say, actually, Alex has got very excited in the past, though I am excited as well, about your ability to map the language that is being used. Disinflation was a word that really stood out on Wednesday. Does your model give us an idea of which words we should be looking for and what impact those words are having?
Yeah, so our natural language processing model guy does look at every single word and actually phrases, right? Because words without context are meaningless. So, certainly the opening statement was more dovish, and words like disinflation certainly made the Q&A even sound a little bit more dovish. But taken as a whole, the Q&A overall was more balanced according to our model versus a more dovish opening statement. So I think that the market, the market reaction was obviously that this was a dovish statement saying things like disinflation. I think market participants, when they heard the word disinflation, confused that with deflation, right? So disinflation is inflation going from 7% to 5%. That's still disinflation, but that still doesn't mean that we're in a situation where the Fed is comfortable with the overall level of inflation, right? And I think that that's kind of some of the nuance that was missed in his remarks. He's having a communication challenge here, I think, because the market is so used to the Fed, the Fed reacting very quickly when the economy starts to roll over, the so-called Fed put. But that put now, the strike of that put is now way out of the money in my view, and I think that that's where the market is kind of disconnected from what the Fed is saying and doing.
Yeah, you've been saying that for a while, Ira. Also, as we learned from the RBA, inflation can go up again and rate hikes can come back again. Guys, thanks a lot. Mike, Ira, wonderful reporting and analysis for us. Looking forward to the coverage coming up later this afternoon. Fed Chair Jay Powell is going to be sitting down with David Rubenstein. We're going to bring that to you live today at 12:30 New York time. All right, coming up, Mona Mahajan, a senior investment strategist at Edward Jones, joining us for her take on what markets are going to be listening for from Powell. This is Bloomberg.
President Joe Biden delivers the State of the Union address. Join David Weston and Bloomberg's top political reporters and analysts live from the Bloomberg headquarters in Washington, D.C. as President Biden lays out his plans to tackle the war in Ukraine, Congress's debt limit standoff, immigration, and more. And stay tuned after the speech as we break down the Republican response. Special coverage starts at 8:30 p.m. Eastern, simulcast on television and radio, only on Bloomberg, your global business authority.
We think about why we've seen the equity rally to start this year. It's because we saw real interest rates fall. They started at 1.6%. They fell to about 1.1%. But now they're back up to 1.3, 3.5. And yet we have not seen valuations reflect these higher real interest rates. So we've gone from 23 times to start the year on the NASDAQ, but we're now trading at 27 times. That hasn't wobbled. And so we think that the real risk is now again back on the valuation front for equities because we're at the high end of historical ranges.
That was Cameron Dawson, CIO of New Edge Wealth, earlier on Bloomberg Television on the risks to the equity rally. So our question of the day, will markets listen to Powell, ... this time? Joining us now, Mona Mahajan, a senior investment strategist at Edward Jones. Mona, we're twinning. I just want to acknowledge that at the moment. Do you think the markets are finally going to listen here?
Yeah, you know, it was interesting. I think at the press conference last week, Powell was explicitly asked, what do you make of financial conditions easing? And he didn't take the opportunity to push back on that. In fact, he outlined that financial conditions were actually tightening. Perhaps if you look at certain metrics like mortgage rates, for example, and make the case. But more broadly, financial conditions have clearly been easing by a number of popular indices. So what I think will be interesting for a lot of market participants this afternoon is if he takes that opportunity today to now finally push back on what we've been seeing really since the start of the year, as we have seen, you know, growth outperform value, as we've seen some of these more speculative parts of the market rebound, even as we've seen small cap versus large cap international equities. There's been a real easing in financial conditions that may not make the Fed too comfortable, especially given that easing financial conditions could ultimately be a driver of inflationary pressures too. So I think that will be the key for today's Powell messaging, to see if he reverses on that message as well.
Mona, how far do you think he is going to have to go? Good morning, by the way, it's Guy. How far do you think he's going to have to go to convince the bond market that there will be no cuts this year? Because at the moment, the bond market's saying there will be cuts this year, and the equity market's saying, great, we like that, and as a result of which we're seeing stocks rally.
Yeah, absolutely. Look, I think after the jobs report on Friday, we did see a little bit of transition in expectations from the markets there as well. The terminal rate moved higher. Markets are now expecting about a 5 to 5.25% terminal rate. We also did see this a little pushback in when the first rate cut may come. And in fact, if you look at, you know, the CME FedCast tool, it's showing about a December timeframe where we get a first rate cut. So markets are starting to maybe think about the Fed may remain elevated for much of 2023 and not think about rate cuts maybe till the end of the year. You know, in our view, they could start to signal rate cuts. They're having a conversation about, you know, rate cuts by year end, but, you know, may not be executed till early 2024. I think Jerome Powell will have to kind of take that stance. And it's a message that's been pretty consistent from himself and a lot of Fed speakers probably this week as well, that rates are going to remain elevated for some time now.
Yeah, which is where I think it seems like it might get really confusing. So that's the one narrative. The other is that we all thought we were going to get a recession in the first half, and that seemed to be consensus, and that appears to now be somewhat off the table. So then you have to sort of re-risk or re-shift based on that view, while at the same time try and calculate higher for longer rates. What do you do with that?
Yeah, you know, it is a tough one. You know, I think the recession fears have been alleviated to some extent given the better data we've been getting. You know, it's not only that resilient labor market we're seeing, we also are seeing better trends in inflation across the board. And by the way, the global picture has stabilized somewhat, with a European recession now seeming not as imminent and China reopening as well. So there are certainly better trends that are underlying some of this market performance we've seen in 2023 thus far. Now, what we would say more broadly, though, is that we
we wouldn't extrapolate, this first month and a half to the full year. We kind of know markets don't go up in a straight line forever. And in fact, as we are getting higher in not only performance but valuation, the market does become more vulnerable to potential downside risks or downside surprises. Now, some of those downside surprises could include things like the earnings story. If you look at the earnings story, Q4 looks like it will be a negative 4% or so. But what's interesting is Q1 and Q2 are now also expected to be negative earnings growth quarters. So that's 3 back-to-back negative earnings growth quarters in the last, from Q4 to Q2 of 2023. And so that could be, markets may not be able to completely power through that, which I think could be a source of some volatility. Now, we would expect some volatility in the months ahead, especially as we're kind of digesting maybe not recessionary growth, but slower growth, slower earnings growth. And really, though, what we're saying is that is kind of the opportunity to position yourself for more sustainable recovery ahead.
So Mona, just go back to that earnings issue. Q4, Q1, Q2 all look fairly bleak right now. Is that as bad as it gets? One would assume that it would be. Is that the low? When does the low come? Because a lot of people had anticipated it would be Q4. What you're now saying is it could be maybe significantly later than that.
Yeah, I think it will depend on where the Fed terminal rate ends up being. So, most people thought we had maybe one more 25 basis point rate hike in March. Now it looks like May is back on the table for an additional 25 basis point rate hike. And those rate hikes do act with a lag impact, as we've been saying for probably the last 12 months or so. And so probably what we're going to see is sometime in the first half or maybe, third quarter of 2023, we are going to see that slowdown kind of materialize in the economy. Now, our view is still that we don't expect any sort of meaningful downturn, but nonetheless, it could create some market volatility.
We just lost you there for a second, but let me ask one quick question if we can. What does that mean for the dollar, and how does that feed into earnings?
Yeah, absolutely. So I think our view on the U.S. dollar is that given what we're seeing in global growth, we do think that the dollar will continue in spurts to start moving lower. We've had a pretty nice move downward already. We think there's a period of consolidation to kind of digest that move. But then we do think as global growth stabilizes, maybe towards the back half of the year, we see the dollar continue to soften. And that will support, any global earnings here from U.S. corporations, but also will support broader international markets, especially those EM economies and EM markets that we do think will continue to show better performance in 2023.
Well, great to catch up. As ever, we always appreciate your input. Thank you very much indeed for being on the show. Mona Mahajan of Edward Jones. What do we got coming up for you next on the show? The Ernie Bot. Baidu joins the AI race. Everybody's getting in on the act. It's on track to roll out a ChatGPT-like service in March. There are others that are going to follow. Details to follow on this program. The startup is next. This is Bloomberg.
Jobs Day, like Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares of Bed Bath & Beyond plunged at the open, down a record 48% at one point. The struggling home goods chain announced a share sale that it's expected to raise about $1 billion. Meanwhile, Wedbush Securities analyst Seth Basham says the stock will soon be worthless. He called the equity financing a last gasp. Hertz posted fourth quarter profit that beat estimates. The rental car company says that corporate and leisure travel are both on the rise, but falling used car prices played a part in profits declining 45% from a year ago. And BP has joined other giant energy companies in posting a record profit for 2022. The UK company reported earnings of more than $27.6 billion for the year. Now shareholders will reap the benefits. BP is boosting its dividend and will buy back an extra $2.7 billion worth of shares. And that is your latest Business Flash. Sky.
Ritika, thank you very much indeed. So it is now 22 minutes past 7 on the West Coast, so it is time for the startup. We are covering the top tech stories from the Bay Area and beyond. This, as you can see, Silicon Valley starts its morning. What an amazing shot. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, it seems that everybody wants a bit of the GPT chat bot story. Everybody wants to get involved now. There is clearly money to be made.
Yeah, so overnight the big news is Baidu confirming that it will release a ChatGPT style bot called Ernie by March of this year. It's kind of in early testing phase, but they're planning a wider rollout. This confirms an earlier Bloomberg scoop, but the shares, both its Hong Kong listed shares and now its US ADRs are just going absolutely nuts on this. You know, Baidu's a really fascinating company. It's essentially the Google of China. You know, when Google exited that market, Baidu runs its own search engine, its own search business, and this could mark China's first real foray into the chatbot space.
Ed, am I taking any warning from this? Like, is there bubbly? When all the big guys get in and there's so much drummed up enthusiasm, I get a little worried.
Alex, I'm going to be honest with you, I lost you in my ear, but what I think that you said was, what's Microsoft doing today? And because I'm hoping that's a good guess, I'll go with it. So Microsoft has a mystery event at 1 p.m. Eastern, a mystery event, but come on, we know it's about artificial intelligence. Sam Altman, who is a leader at OpenAI, he tweeted a selfie with Satya Nadella, who, of course, is the CEO of Microsoft. So our assumption is that this is going to be the next iteration of whatever Microsoft is doing to ingest OpenAI's technology into its own business. But we'll have to wait and find out. As I said, I've lost you in my ear, so I'm hoping I got that question right.
Can you hear me now, Ed? And how did you do that? Because I'd like to do that in the future as well.
To be fair, that wasn't the question that I asked, but still, it's fine.
I know. Okay, I don't think he can hear us.
Oh,
I can't hear you either.
Okay.
I don't know. Anyway, I don't know how you make, what I think is going to be interesting here is this another trend that ultimately everybody piles in on, and then everybody realizes that it's a struggle to make money from? And I think there is some significant danger of that. Clearly there is going to be a lot of progress here, but monetizing it, I think, is going to be extremely interesting. And is it going to live up to expectations?
Well, and that was kind of my point, that like when all the big guys are getting in and spending a lot of money, does that get too bubbly? Like that makes me a little bit worried when there's just sort of the one consensus move. I also wonder on an application basis, like there was a great article, I think it was in the Journal, that was talking about how professors, for example, are rethinking how they give homework and do papers and stuff because of this. So it's going to like have huge effects. And when it's that transformative, then, I don't know, regulation comes down, other stuff happens.
My kids are already aware of it.
Really?
My eldest son, 14, is aware that it is a phenomenon out there. So it's going to be really interesting to see how education ultimately deals with it. More kind of in person, more verbal. They're talking about the fact that a lot of homework, etc., is going to have to be delivered in a more verbal form.
Yes.
Otherwise, it's going to be very hard to tell. Anyway.
That would be good for me. I'm more of a talker than a writer, but still, nevertheless. I do think it's quite interesting looking at the Microsoft's announcement then later on today, and then how do you value it as an analyst or as an investor? All right, well, coming up, President Biden will deliver the State of the Union address tonight. Polls show an increasingly skeptical American public. We're going to break it down with Terry Haynes, Pangea Policy Founder, next. This is Bloomberg. we're about an hour into the U.S. trading session. Stocks a little heavy, but really no action headed into Powell speaking later. Abigail's tracking the moves. Abby?
Yeah, a small decline on the day, but over the last 3 days, Alex, we can see a bit of a pause here for the 2023 rally, down about 2% at this point, sort of near the session lows of these last 3 days. So everybody waiting on Fed Chair Jay Powell. What will he say? Something to remember there is he is, of course, an attorney, and David Rubenstein also. So in terms of the questioning, they're saying exactly what they want to say. So if a new message comes out, it will be very intentional in my mind. This chart may suggest that it will be steady as she goes. We'll see. But the reason that we do have this 3-day decline, it has everything, of course, to do with that hot jobs report and the action for the 2-year yield backing up about 30 basis points over the last 3 days. Now today, flat to in on the day, but that big backup over the last 2 days really pressuring stocks to some degree, especially the technology stocks. However, this is just a minor dent on the year. If we take a look at what we have going on the year, I mean, this is incredible. We're not even 2 months in. We're about 6 weeks in, 5 weeks in. We have the S&P 500 up 7%. We have the NASDAQ 100 technology doing even better, up about 14%. The stocks up 20%, and then take a look at even the Dow transport. So this is a broad-based rally on the year. Lots of different sectors participating. And if we were to take a look at the 10-year yield, it is actually up on the year, down on the year by about 23 basis points. So really providing some relief there. As for another stock that's wildly actually higher, if you can believe it, on the year, it is Bed Bath & Beyond. Take a look at this, a big spike up here earlier in the year and then down. The massive move up yesterday, about 50%. Today's record move at one point, down 48% around the open, a pause. Net, I mean, it's hard to understand exactly, Guy, with so much going on in terms of one analyst saying that it has a price target of 0, their new share offering trying to raise $1 billion. Have you ever heard of a $0 price target? I actually have not in my entire career. Pretty bold.
Yeah, I think we may be to the beyond point at that stage.
Oh.
We've done the bed, we've done the bath, we're definitely beyond. Abigail, thank you very much indeed. I went to one the other day. It's a new experience.
I like this.
Thought I'd get it in there.
That was good. I like that one. Go ahead.
To infinity and beyond. Okay. Talking of which, I'm not sure how I'm going to make this link. President Biden, Alex, is going to deliver his State of the Union address tonight. He's expected to highlight the accomplishments of his first 2 years in office and lay out his vision for the next year. It may, though, be a tough sell. A new poll from the Washington Post ABC shows that 62% of Americans don't believe that he has achieved much since taking office. Here was some perspective on that. Terry Haynes, founder of Pangea Policy, a Washington think tank. Terry, you think tonight's going to be a non-event. Why?
Well, I do, for a couple of reasons, Guy. One is that the president is interested in using this speech to make his case to the American people, and it's kind of a curious thing to make your case after you've already done a bunch of things. So there's that. I think Biden is also in a situation where a lot of the achievements of his administration have happened without him. That's certainly true of both infrastructure and the interestingly named Inflation Reduction Act, where he was told by congressional negotiators not to be part of those negotiations if he wanted them to succeed. So, he gets to take credit for what he wants, just as any president does, and that's fine. But at the same time, what he wants to take credit for, in large part, he's not responsible for, whether it be the economic uptick or stubbornness, if you will. That's largely the Fed policy doing. But what he'll emphasize is a combination of good economic news, bipartisanship on foreign policy, and a number of domestic initiatives that won't go anywhere but are red meat for his base, stock buybacks and things like that.
Yeah, I was going to say, the buyback thing, billionaire tax, that's the sexy stuff that Wall Street's going to be watching. Non-starter?
DOA.
Is there any part that may gain traction in some capacity? Like, would companies start to rethink how they allocate capital? I have a hard time thinking that would be true, but anything there?
My view is no. They'll hear from a variety of sources, including this program, that the answer is, this isn't going to happen, and you shouldn't worry about it, and that'll be the case. Even with something like the Inflation Reduction Act, which was done purely on a partisan vote on the unique reconciliation process that only needed Democratic votes. That's not going to be available this year when one house is Republican. Yeah. So, the net is anything contentious won't happen.
Is he putting those things on the table for the debt ceiling negotiation? Is he setting the table for the debt ceiling negotiation? You guys want us to cut spending. You guys want the government to be smaller. We want to be able to solve some of those funding issues by raising revenue from billionaires, etc. Is that going to be the way that the table is set for that negotiation?
That'll be part of it, Guy, but I think fundamentally the way that negotiation goes is the president and Democrats say, look, this isn't about money we're going to spend in the future. This is money about that's already been spent. What they'd like to do politically is get the Republicans in the trap of talking about efficiencies in Social Security and Medicare as a reform to contrast Biden, who they'll characterize as the safe pair of hands with these risky people that want to play around with entitlements. That's kind of the political game that's happening here. But, debt ceiling will take quite a while. And my view is that centrists, both on the Democratic and Republican side, will have a lot more to do with what the final package looks like, including spending reforms, than either Biden or Speaker McCarthy.
Terry, how quickly do you think they're rewriting any graphs on China right now?
Rewriting what? I'm sorry, Alex?
Any paragraphs on China right now?
They're continually rewriting those particular paragraphs. But what they'll focus on is a resolute China policy that is bipartisan. And broadly speaking, both of those words are true. It's also important to distinguish that what's not happening here is whataboutism, where it's Biden figured this out, whereas Trump's people didn't. The Pentagon itself says that they were very late to figuring all this stuff out, other balloons and the like, in the Trump days. And so what you've got is, you've certainly got a national security problem here that needs to be rectified, but it's not something that dissolves into a neat political talking point.
Terry, from the market's point of view, how should I be reading this? If I'm an investor in defense stocks, is this going to be good for me? If I'm an investor in healthcare stocks, is this going to be bad for me? Break it down along those lines.
Well, I think there's a number of things. Mostly what I would say to markets is that what you think is happening in Washington, what's good or bad or indifferent, is already happening and will continue to happen. This speech won't change very much. You get market positives in defense, aerospace, semiconductors, and the like, for a variety of reasons that, as I say, already happened. The CHIPS bill and the like. I think healthcare is largely status quo because there won't be any major changes to healthcare this year or next. You got a couple of negatives. Pharma is still dealing with the beginnings of drug price negotiations, and you've got metals and mining are having problems thanks to permitting problems that haven't been resolved yet. But generally speaking, there's not going to be anything new in this speech that'll be a breakout or change what investors already think is happening in Washington and how it might affect their own investments.
Yeah, and talking about like building a pipeline isn't that sexy for the State of the Union. Terry, are there going to be any hints about re-election?
No, I don't think so. I think they'll they'll assume that people think he's going to run anyway, and that what he's trying to do is provide future plans, future view that certainly plays well into his reelection, but there won't be any explicit reference to it.
All right. Terry's not excited, but he is going to be up watching. Terry Haynes, founder of Pangea Policy. Thanks a lot. And tune into Bloomberg's special coverage of the State of the Union tonight, anchored by David Weston at 8:30 p.m. New York time. All right, coming up, you got fast food giant Chipotle reporting after the bell. You're looking at higher menu prices. Does that beef up profits? We're going to break it down with an analyst who's bullish on the stock. John Tower of Citigroup is next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The death toll from those powerful earthquakes that struck Turkey and Syria has now topped 5,000. Rescue crews are still searching through the ruins of thousands of buildings looking for survivors. Turkey's President Recep Tayyip Erdogan has declared emergency rule in 10 of the country's provinces. The US has begun to recover some parts from that Chinese balloon that was shot down off the coast of South Carolina. The military says one concern for recovery teams is whether the equipment carried explosives or other hazardous materials. China has made a formal diplomatic protest over the balloon being shot down. And inflation is taking its toll on the biggest meat company in the US. Consumers are buying less chicken, beef and pork, and that led to a 70% drop in quarterly profit at Tyson Foods. Prices for some meats have been falling from record levels. Global News, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Alex.
All right, thanks so much, Ritika. Let's stay with food for a second. Chipotle is going to report results after the bell. Analysts are expecting a boost from higher prices. And John Tower, our Citigroup director, joins us now. He's a buy rating on the stock and a price target of $1,986. Hey, John, Chipotle has been passing along their prices. How successful will they be in that? What will we learn this quarter?
Yeah, I think they're going to be just fine passing it along. I mean, they've already guided to negative negative traffic growth in the current quarter, which would be the same thing as what they saw during the third quarter. I think they're being absolutely fine in terms of passing along that higher pricing to the consumer. It'll run roughly 15% above a year ago. That's going to drop down to about 11.5% starting in the first quarter. Some of the pricing rolls off. And, I'd be more nervous if they were doing it in a vacuum, but the whole industry is taking quite a bit of price. And if you go back and link it to the cumulative pricing from really the start of 2020 until now, they're only outpacing the category by a modest amount, about 100, 200 basis points when you back out the delivery impact. But generally speaking, they're taking price like everybody else. Their aggregate traffic, cumulative traffic since 2019 to now, pre-COVID till now, is actually still positive. They're one of the few names in the category that's still seeing that. So we feel good about what they're doing.
How much longer, John, do you think that they can continue to deliver these price increases? There is some evidence, and Carlsberg, the beer company in Europe today, was talking about this. Maybe we're reaching the limits of our ability to continue to price higher and higher to deal with the margin cost that we're facing. Do you think that is going to be an issue anytime soon for Chipotle?
They are going to let some of the pricing roll off this year. So they'll start the year in that low double-digit range. It'll likely tail off by the end of the year. However, I do expect them to take another, say, 2 to 2.5% pricing by the fourth quarter. It's the new philosophy, a relatively new philosophy under Brian Nichols' tenure, to take more annualized pricing as they move along versus large chunks as they move throughout the years. So I think they'll take a modest amount in line with the category's inflation, which, by the way, I think it's important to note that the food spot market prices that we can look at across the board have certainly come off the boil. They're elevated relative to, pre-crisis levels, even versus 2021. Year over year, they're down. So it's certainly moving in the right direction for the industry, and certainly supports the idea of the industry not taking as much price. Flip side is labor inflation is still there. That's not going away. They've absorbed a lot of the pricing, or a lot of the wage increase step-ups about, May of 2021 when they really got into raising the hourly wage rate. So I think we're going to see more modest pricing going forward here.
So what's the next catalyst then for the stock to get to your price target?
Yeah, I think it's continued execution. I think we're going to see a better path here on margin improvement. There's a few things that they're doing at the store level, a big throughput initiative. They've installed some software into the stores over the past 12, 18 months that will allow for better labor management. But if you think about it, COVID really disrupted their operations. It was a high throughput business model. There was decent digital penetration. COVID essentially overnight changed it to a mobile order ahead and pickup business. So a lot of the employees that got hired from COVID start through the past 24 or 12 months have only been dealing with people doing mobile order ahead, not necessarily dealing with the line that perhaps you and I are used to going in. And therefore, these people need to learn how to be in the right spot at the right time, get all of the right ingredients out at the right time such that they can manage the stores better. And the company's even said, look, if they can get 5 more transactions per store per day, that's going to be a point of comp. And they're zeroed in on this, which will be, I believe, a pretty significant driver. You marry that with falling input prices, so commodity inflation being less of a headwind this year. Those two things should help them with store margin expansion, which should allow for greater earnings growth this year.
Okay. Details matter, I think, is definitely the message on that front. John, final quick question. At some point, the anticipation is that the US is going to go into a recession. How does this stock fare? Is it a good place to hide out during a recession? And how much of that anticipated defensiveness around the stock is already priced?
Yeah, I think it's actually a very good name to be involved in because it's going to be a scarce name, or growth will be scarce within the category, right? Generally speaking, the industry, the full food service industry, picks up about 200 basis points of wallet share during slower economic times at the expense of durables. And within that, you want to own brands that are winning traffic share or aggregate share from competitors. This brand will be growing their same-store sales based on a number of different initiatives at the store level, as well as growing their store base at a high single-digit, low double-digit clip. They're accelerating share with a fairly favorable margin backdrop for them going forward. I think that's a great recipe for a business you want to own during an economic slowdown.
Perfect. John, great to chat. Thank you very much indeed. We'll look forward to the numbers a little bit later on. Really anticipate the input. John Tower, Citigroup Director, thank you very much indeed. What have we got coming up for you? Top money managers. They've been discussing the next big risk for markets. Details on what they're watching and how they anticipate navigating these risks. Well, that's coming up next. This is Bloomberg.
stocks pretty much go nowhere as we wait for Jay Powell. So it gives us an opportunity to talk about the biggest risks from the biggest market participants. They're really trying to look a little farther ahead and ahead of position. So Bloomberg Sonali Basak sat down with Karen Carniel-Tambor, Henry McVeigh, and Sarah Malik to find out what's keeping them up at night. And Sonali joins us now. What was the biggest takeaway from you, or the biggest surprise, I should say?
I think one of the most striking is, as we were listening to the market talk a lot about the potential of a soft landing, you're hearing Karen Carniel-Tambor talk a lot about this idea of the fact that there could be deeper and longer recessions. Now, I think that's an interesting concept in the vein of this idea of less liquidity in markets. What happens if the central bank can't step in anymore? And you have her talking about this idea here that governments may have to step back in more and more. I asked her, how much can governments step in? Is there a limit to which governments can step in? And she goes, listen, you can see it in different parts of the world. It's basically until the market tells you they can't anymore. So it's very closely tied to this kind of debt conversation we're having in the United States and abroad among emerging markets. But this worry that recessions can come more often is a big issue for her.
That's interesting. The UK has learned the lesson that you can't push the market around too much, and I think that was a lesson certainly that the Liz Truss government found. In terms of government's ability to be able to act in those crises, though, given that we have significantly divided governments, the United States is a perfect example, is government going to be there, and what's the view on that?
Yeah, and that's the big question. What does political gridlock mean in these sorts of circumstances, particularly after COVID, when you saw the government step in such a big way? The bigger issue, Guy, we're sitting here talking about the Fed every day, all day, because it's the biggest game in town. It's the only game in town in so many ways. But if you think about it, what you're seeing here with both Bridgewater as well as KKR, this concern that what's happening both in the economy and the ability of the Fed to kind of be offset by the federal government, what does that mean for central banks? Does that start to make a central bank's job harder in any fashion? You're seeing that compounded by an issue that Henry McVeigh over at KKR brings up, this issue that the labor force is really distorted here and across the world because of a lot of factors, both because of immigration changing in a big way. That's a big issue among a lot of investors, comes up consistently in this project, which we do twice a year. And this idea here that maybe the central banks are losing control of the labor narrative, let alone the inflation one.
Well, then to that point, it's sort of like it's not just COVID, it's going to be demographics, it's going to be people retiring and things that cannot be fixed overnight.
Yeah, absolutely. I want to point out one more issue here, because we're talking about inflation and the forms of inflation people face in the labor force, wages, and whether those wages are real wages are really meeting what you need to see here. But there's another inflationary force that Nuveen Sarah Malik really brings up here. She talks about another force of inflation that, again, complicates things for central bankers, which is that energy transition. Government role there. Once again, she talked about the Inflation Reduction Act, but this idea that this transition can create more inflationary forces than perhaps the eye today.
Yeah, indeed, yeah. And also, it needs a lot of money pouring into it. In some ways, how can an energy transition not be inflationary? All right, Sonali, thanks a lot. Looking forward to the event. It premieres 9:30 p.m. at New York time tomorrow. The next big risk. Make sure to check that out, Guy.
Yep, let's talk about where we are with European markets. Talking of what we're watching next, we're very much watching Powell. And to be honest, as a result of which equity markets are doing absolutely nada, nothing. 457 is where we are on the SOX 600. You've got the market basically barely budging, waiting for that signal, waiting for that cue. You are seeing a little bit of dollar strength today, so you've got more euro weakness, more pound weakness. We're down by around 0.3 of 1%. And the UK 10-year yields are, though, continuing to climb. We've got this all the way across Europe. It is a continuing theme that we are going to be watching, I suspect, over the next few days as we see this hawkish statement after hawkish statement after hawkish statement coming from central banks. Powell obviously preeminent today, but we've heard from people like Bostic. We've heard from the ECB over the last couple of days, multiple speakers talking about the need to hike rates. Charlotte Ryland's going to be joining us next. We'll get an assessment of all of this from her, from CCLA. This is Bloomberg. Tuesday, the 7th of February. We are waiting for the Fed. That is clearly the message the markets are sending right now. Below the surface, though, there's some really interesting stocks. Chip stocks are being pummeled in Europe. Energy stocks are absolutely flying. That's the narrative. We're going to dig into it over the next hour. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
30 minutes to the close. At a headline level, nothing is happening. European stocks, as you can see, flat as a pancake, 457, spot 22. However, the rotation is interesting. Take a look at these two stocks here. BP up by 6.95%. Let's call it 7%. The stock is delivering oil profits. The market likes that. It's also putting the emphasis maybe on those oil profits rather than the renewable future. Market seems to like that as well. Is this a pivot? We'll debate that in just a moment. Compare and contrast though with AMS Osram, the chip stock. Down hard today. The European chip stocks that have done well recently are those that are exposed to the auto sector. If you are exposed to the handset sector, it is a less good picture. Osram down really hard today, and that's the story here. It's about earnings. Headline level, nothing happening, but the earnings sort of division is becoming clearer and clearer as this Q4 earnings season unfolds, Alex.
This is what I'm going to say. Guy's right, because it's exactly what's happening here in the U.S. S&P is down just, 0.2%. Nothing to write home about as we wait for Powell speaking with David Rubenstein in just a couple hours. But let's peel it back a little bit, because Royal Caribbean is the best performing stock in the S&P, dragging up its peers as well. It's looking at a record 2023 adjusted EBITDA forecast. They're also looking at their season, which is January through March, being really strong. You would not necessarily think that if inflation is high and the consumer is a little wobbly. So really interesting read-through from Royal Caribbean. Now, Bed Bath is a bit different. Yeah, that stock is down 46%. That's pretty rough. So they are looking at a capital raise of $1 billion. Wedbush saying cutting their price target from $1 to 0. That market getting just totally pummeled right now. The 2-year yield is down 3 basis points headed into Powell. Will the markets listen to what Powell says? How will he eventually address that disinflation as well as the financial conditions that are loosening? He can't deny that. He'll get a follow-up question. We'll see. But the market's really waiting for that on a broader level, Guy.
Absolutely. It is the big events. I do feel, though, that we are hearing so much from both the ECB and the Fed at the moment that if Powell feels like an outlier, that's going to be a really big deal. If people like Bostic are making the hawkish message as clear as they are, Powell needs to in some ways stick to the script that they are delivering. Okay, let's talk a little bit about what is happening in the oil sector right now. We've teed it up. Alex was down in Arizona yesterday talking to Occidental. We've got BP out with numbers today. We've heard from Bernard Looney a little bit earlier on, Alex. In some ways, BP is a really interesting sort of case. U.S. energy stocks, U.S. oil companies are oil companies, and the market is pricing them as oil companies. European oil companies, well, they're maybe partly oil companies. They're a bit oil, they're a bit renewable, and as a result of which, in some ways, they have lagged. And that is the gap that you are looking at on the screen at the moment. Does Bernard Looney, even if I can pronounce that correctly, need to close that gap? And if so, was today a big first step in that direction?
I mean, the market seems to be saying yes. However, you still have to have all this energy transition stuff that BP still has. It's not like you're selling it all.
Yep.
Lots of analysts are talking like, well, maybe they need to spin it off. We've seen this movie before with big oil. For the last 40 years, this has happened. They need to spin it off, make it a separate issue so you can actually value oil and then value the alternative assets. Anyway, lots to get through with that. Bloomberg Television caught up with Bernard Looney earlier today.
We're actually announcing that we're going to increase investment in the energy transition by about $8 billion this decade. And at the same time, we're going to increase investment in today's energy system, which is predominantly oil and gas, by about $8 billion as well.
So the question of the day is, referencing back to that chart we just showed, do you buy the BP pivots? I guess there's something implicit in the question that it is a pivot. We should probably debate that as well. Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy, joins me now on set, as does another Will Mathis, who covers energy and climate change. It's a job lot. Will Kennedy, I'm going to start with you. First up, is this a pivot?
It's more perhaps a little bit of a recalibration, or quite a big recalibration. I think, going back to your intro, it's an admission that investors don't feel they're getting what they need from BP. It shows that oil and gas remains extremely profitable, and I think it shows that when they look at the dynamics of the market over the next 5 years, they see an oil market which is going to remain fairly tight, in which prices will remain fairly high. And one of the interesting things they did today was to say our business plans assume oil price of $70 a barrel, which is quite punchy, but I think all of those things show that they think that oil prices are going to remain, and gas prices remain strong for a while, and that they have the opportunity to lean into that and deliver better returns to their investors as a result.
Yeah, this is where I get confused, Will Mathis, because that is, as Will was saying, a punchy forecast, especially if you adjust it for inflation from a couple years ago. It means even higher nominal prices. But if you take a look at their BP oil demand forecast, they see oil demand rolling over in all three of their scenarios. To me, these two things don't make sense.
Yeah, I think that that's true. And if oil and gas demand continues to go up, you can see in BP's own scenarios that the world is going to stay on the trajectory it is now, which is far from reaching its climate targets, and going to see warming at a level that will lead to a lot of very negative and expensive outcomes. And BP has another thing to think about, which is that Russian fossil fuels are maybe not going to be available. So even if the overall supply goes down, the barrels of oil and the gas coming to Europe is missing supply that it had a year ago.
Let me take it back to the beginning. The chart we showed a moment ago showed US energy stocks outperforming BP. And the reason for that is that I would suspect US energy companies are valued as oil stocks. BP is confusing people. Does BP just need a better message? This is about emphasis rather than action.
I think that a lot of people would say that. BP's message is that they don't need that. They say, short term, we're going to make a lot of money selling oil and gas while prices are really high this decade. They revised up what they expect the price of oil to be in 2030. But long term, they say, the transition is happening and we need another business. And if we just do oil and gas by the time, 2035 rolls around, maybe we won't have anything left for our shareholders if the world goes the way we think it is. So they are trying to find a way to play to that narrative, but so far, most investors aren't really buying that if you look at the valuations of Exxon versus BP.
Well, Kennedy, that's like having your cake and eating it too. And I know that a lot of oil companies in Europe are going to say, hey, we got lots of synergies, right? We're really good at this when it comes to oil and gas. Therefore, we can take this and apply it to wind or solar or power trading. Where is the truth in that for a company like BP that an investor can actually start valuing them on that?
One interesting thing that came out of today's strategy briefing, Alex, was that as well as sort of rebalancing oil versus new energies, they said a few things about what new energy investments work for them. Interestingly, they say the ones that they like, that offer the kind of returns that are acceptable to BP management investors, are biogas, which is gas made from non-fossil fuels, but obviously speaks to their existing expertise. EV charging and the opportunity to sell people coffee and Coca-Cola while they charge their cars. That counts as on their forecourts. That counts as a new energy business, a big business for BP. They said the ones that they're struggling a bit with are things like wind and power trading, where they really need to work hard to get the kind of returns that an investor in an oil major will accept. So again, there you can see the sort of struggle between this is what I can generate from oil and gas right now, which is a return on capital in the well into the double digits. That's not true for wind, so they're having to look for new energy businesses that can do that.
They're struggling with the complicated stuff, basically. Selling people coffees at forecourts, pretty straightforward.
But quite profitable.
Okay, fair enough, but they already do that. Building wind turbines and trading some of this stuff is a little bit more complicated. And that comes back to this issue of would these be better off in two separate companies? Would I, as an investor, and if we come at it from an investor's point of view, have a better understanding of what the turbines business does and all the other side and that side versus the oil and gas industry? Wouldn't it just be easier just to separate the two and therefore be able to navigate?
Look, that's an argument, and obviously if you look at Dan Loeb, the activist who's gone into Shell, that's exactly